The government is claiming on this matter that those same producers and sellers are actually not being able to claim so far input tax credit, and apparently they will now be able to claim input tax credit. Well, this is something that most ordinary people don't know, and the producers and sellers will take advantage of this. So it's going to raise prices, no question about it. And please note that this is a decision that was taken, although apparently by consensus within the GST Council. The fact of the matter is that there is a certain method of arriving at decisions in the GST Council, which is as follows: that within the GST Council, central government has 1/3 weight, and the BJP governments, which have many governments in BJP, which has many governments in power in the states, together will constitute a majority. The opposition states will not be able to constitute a majority. So that is that. And we also know how BJP has been toppling non-BJP governments, opposition governments. It has done so in the case of 5 or 6 states in recent years. This is the way that GST decision making is happening. And please remember that the inflation rate has been running for some time above the permissible band decided by the RBI itself of 2 to 6%. It's been running at 7%. And we also know that food inflation between July 2020 and July 2021 was as much as 31%. This is RBI bulletin data. So this is happening at a time when meaning the GST imposition, new impositions, come on top of a pre-existing inflation rate, which is practically almost entirely driven by government decisions. So what do I mean by that? Yes, it's true that international oil prices have risen compared to 1 year ago. And there is a Ukraine war going on account of which there have been economic sanctions in place. But the point is that the government's own decision making has enabled retail inflation to rise. Retail inflation is running, as I have told you, at over 7%. And a very significant input into that is fuel costs. Fuel costs on which the central government has been consistently raising excise duties and then cesses which it doesn't have to share with the state governments. And since diesel is particularly an input into most other products, that has raised inflation. Now, at a time when unemployment is high, per capita consumption expenditure is down, as the Central Statistical Organization has told us, one would expect counter-cyclical action by the government, which is the government should be reducing taxes like the previous government was reducing taxes post 2008 global financial and economic crisis. This government has been raising taxes. So this is a inflation for which the responsibility lies entirely at the door of the government. Our inflation rate is, on average over the last many years, well above the inflation rate of other countries. So one would automatically expect the rupee to depreciate, the rupee to weaken. Unfortunately, the rupee was not weakening, and I'll come back to why I'm saying unfortunately in a minute, because the government was very happy about the fact that foreign portfolio investment in dollars was flowing into Indian capital markets, one, and two, foreign direct investment was increasing. Now that means also more dollars were flowing in, which means the demand for the rupee was rising, and therefore the rupee was relatively strong. Now, because the United States Central Bank, the Federal Reserve, has raised interest rates, and European central banks are also raising them. Therefore, money is flowing back, dollars are flowing back to their safe havens. Because the demand for the dollar has risen, the dollar has risen, the dollar has strengthened. And as the dollar has strengthened, the rupee has weakened. All currencies have weakened, but I mean, the point really is that this is an important reason why this is happening. Now, please try and appreciate that in this context, obviously, we are going to import inflation, which is sort of inevitable. The government of India has no control over what the Federal Reserve does. The government of India has no control over what international oil prices are like. So therefore, it becomes incumbent upon the central government of India to actually bring down inflation, which means subsidizing, not raising taxes and cesses on diesel and petrol, which is driving the inflation rate. I think the number is that in the last 7 or 8 years, this government has collected in the region of 28 lakh crores in terms of tax revenue and excise revenue on petrol and diesel. So it could have used some of this in a time of economic crisis and job loss and consumption decline, because per capita consumption today is still lower than it was in 1920. So for all these reasons, it is the responsibility of the central government to play the role of protector of the poor. But that's not what the government is doing. Prior to COVID breaking and the lockdown, we already knew that in 2019-20, the open unemployment rate was at a 48-year high. And the employment rate, which is the share of the working age population, which is constantly rising in our young country, relatively young country, the employment rate, that means the share of the working age population which has got work, was consistently declining. So on the one hand, employment is falling, and on the other hand, unemployment rate is increasing as more and more young people are looking for work. So CMI data was telling us that 2016 the employment rate was 43%. In 2021, that was down to 37%, a 6 percentage point decline at a time when the numbers in the working age population are rising. So people stop looking, they become so discouraged, they stop looking for work. And in this context, please recall that in the first wave of COVID in 2020 and in the second wave of COVID in 2021, millions of people left the cities to go back to their rural homes. In other words, reverse migration took place. So the absolute number of workers in agriculture for the last 2 years has been rising. We have an exact number of how many people joined agriculture between 1819 and 1920, thanks to that reverse migration in the first year. It was 30 million plus. The periodic labor force survey tells us that. What is the implication of that? The implication is that inevitably demand for Manrega rose dramatically, but open market jobs in the rural areas were very few. So real wages were falling, which is the reason why that incomes are falling. So that's the overall situation. It's a very grim situation. And at the same time, manufacturing jobs have fallen in the last 5 years. They've halved. They halved. So despite Make in India, manufacturing jobs fell. This is despite what we were being told about Make in India, and also the ease of doing business improving and all that, and our ranking improving. Jobs are not getting created. So after a few years of looking for work, people drop out of the labor force. They stop looking for work. Now, the government, of course, thinks that it's doing all the great things that are necessary for jobs, like it's doing mudra. Well, let's just look at the reality of mudra. The reality of mudra is that despite the millions of new loans that have been given in under mudra, 95% of those loans do not exceed the value of about 27 or 29,000 rupees to each individual new borrower. Because 95% of those loans are in the Shishu category, where people are, can borrow below 50,000 rupees. Now, can you imagine in 3 years, they also have to repay whatever they borrow. They borrow only 27,000 rupees. If they also have to repay, then what can you do with 27,000 rupees and start a new business or increase your new business? And how much additional can you earn in order to be able to repay? So people are not being able to repay, which is the reason why non-performing assets in mudra loans are rising. And similarly, this Swaniti given or 10,000 rupee loan, instructed, again, government instructs the banks. The banks are the ones who are to keep giving loans to these people. So Swanidhi was supposed to be given 2 years ago of about 10,000 rupees. NPAs are growing even on that because this is non-collateralized loan. So we are in a deep crisis because we know that post 2016, the demonetisation, and then 6 months later, the GST, which had a massive adverse impact on the unorganized sector. MSMEs have been closing down, and they've been closing down particularly fast in the last 2 years under COVID. And they are the ones who provide non-farm employment. Macroeconomics 101, we teach this to our students, says that in a time of a downturn in the economy, the government is supposed to stimulate the economy. What does stimulate the economy means? It means, one, reducing taxes. The government has done the opposite. The second thing it could do is increase expenditures. Well, the government did increase expenditures somewhat, but the size of our fiscal stimulus, direct expenditure by the government, was only 2.1% of GDP in FY21. And to that was added about another additional 1% of GDP in FY22, the second year of COVID. Compare this to emerging market economies, on average, giving a fiscal stimulus of 4.7% of GDP. These are among the reasons why our economy contracted severely by 6.6% in FY21, when the world economy contracted in FY21 only by 3.1%. So clearly, the government needs to, one, cut petrol and diesel taxes, because that's putting money into people's hands. In addition, in order to cover the gap between expenditure and revenue, it needs to put surcharges on personal income tax and also on corporate income tax. please let me remind you that corporate income tax was reduced from 30% to 25% in one stroke, in one blow, in the middle of 2019. And prior to that, in the 1st of February of 2019, in the budget just before the elections, the 2019 elections, the personal income tax threshold was raised from 2.5 lakhs to about 5 lakhs. And one of the implications of that, and then the tax rates were also lowered as you went up, above 5 lakhs. The result of all this was that about 75% of the taxpayers of our country went out of the tax net. This is a government decision. So the combined result of all this was that the government of India lost on direct taxes alone about 2 lakh crores per annum. On the other hand, the government is actually extracting something like 3 lakh crores from us on tax on petrol and diesel. Because until recently, the price of international crude was actually quite low. This government has benefited from a windfall gain for about 5 or 6 years. So that's the second thing that the government ought to have done. And the third thing, to generate jobs, is it has to, once it's mobilized revenues, it has to introduce an urban employment guarantee. So if the government did this much, I mean, that itself might give relief and perhaps revive the economy, because it's true that there has been a recovery of the economy in FY22. But thanks to oil prices rising, the continuing economic sanctions, international economic sanctions, the situation is becoming very grim. The international environment is becoming very grim. And in this context, it's very important to remind ourselves that, so this is a fourth thing that the government needs to be very careful about. It shouldn't be very excited about foreign portfolio investment coming into our international market, because that actually strengthens the rupee. A strong rupee is not good for India's exports. And exports actually fell under this government for 6 years running after it came to power. They've only recently climbed up, and that's why you keep hearing about this increase to $400 billion. Well, what the government inherited was in 13-14, the merchandise exports value was $318 billion. Every year after that, it was lower, which is unprecedented in India's post-economic reforms history.